Now it's 1:30. It's time to start. Good afternoon, ladies and gentlemen. Welcome to 2022 Iafico conference. The title of today's seminar is Big Data, Artificial Intelligence, and Financial Consumers. Current practices and policy implication in the insurance and lending sector, which attract so much interest from both academia and industry. My name is Seung-Dong Yu from Sangmyeong University. It is my pleasure to be here as a moderator. As the moderator, I have to note that this seminar is jointly organized by International Academy of Financial Consumer, Iafico, Institute of International Trade at Seonggyungan University, Korea Academy Society of Financial Planning, and Finance and Happiness Network. Today, we have distinguished guests from on-site and online. Online audience, please click the mute button I think at the bottom left corner, please. Before the presentation, we are honored to have Iafico chairman, the chairman, Professor Cho from KDI school. I believe he put much effort to organize this seminar. Let's give him a big hand, and he will give a welcoming remark.
Okay, this is Mancho. I was just introduced by Professor Yu, and I welcome everyone. For those who are participating online, as well as on-site here. So in total, we have about 20 people who attend this seminar. And I'm sure there will be more people to join us later on. And before give my opening remark, I just wanna thank Professor Hong Ju-jung to provide this wonderful lecture room, which is a fairly high-tech lecture room. Also, we have three panelists who are joining us from outside Korea. So Professor Daniel Schwartz from University of Minnesota. And I really appreciate your participation, even though it's approaching the midnight there. And also Professor Hoshino from the Waseda University in Japan, and Professor Le from Vietnam National University. So I particularly appreciate those people who are joining us through online from other countries. Now, let me briefly speak about why we organize this conference. And this is one of the occasional seminars which became easier because of COVID. You know, we can organize this kind of online international seminar more efficiently and more cheaply these days. And we have 3 concepts in the title of this seminar: big data, AI, and financial consumers. So Professor Chung and a number of us have been thinking about this issue because in almost all countries, these data and technology-driven innovations in the financial sector are becoming critical issues, both in the industry as well as for the government. But I think the platform, the internet and mobile platforms, which is a sort of a front end of the innovations in the financial sector, has been discussed a lot by many people, both in the industry and in the academia. But we believe that real critical elements of these innovations also include the big data and AI, which can be a crucial input in the back end. So the whole motivation of this seminar is to hear about what's happening in 2 particular financial service sectors, insurance and lending, based in terms of utilizing those inputs, big data and AI. And one more thing to comment is that we have both benefits from utilizing these inputs, but as well as costs. There is the risk of using big data and AI. So in the presentation session, we have 3 presentations, 2 from Korea and 1 from the US, which I'm sure will cover both benefit side as well as cost side of these data and AI-driven innovations. So I just hope you will have a fruitful time out of this seminar. And one last remark I want to make is that our staff, both Dr. Im So-young and Ms. Julian Kim, did a lot in preparing this seminar. So I also want to extend my appreciation to them as well. So with that, I will just turn it over to Professor Yu again. Thank you very much. Yeah.
Thank you, Manju. We have another distinguished guest, the Iafico founder, Professor Jung Hong-ju from Sungkyunkwan University. Join me welcoming Professor Jung.
Okay. Good afternoon and good evening, everyone. It's my great pleasure to have you all here. I'm standing here to welcome all of you to this wonderful and nice seminar hosted by the Iafico. SKKU, the Sungkyunkwan University, is co-hosting this seminar, and I'm representing the SKKU today. There are a bit to introduce to you about the Sungkyunkwan University. Sungkyunkwan University is very special in a few sense. Number one, SKKU was the first university to provide official or formal insurance education in Korea since 1974. When SKKU founded the first insurance department in Korea. It was the 3rd in Asia or so. Okay. Number 2, SKKU was the place where the Iafico was born. in 2015 when I and many colleagues were joined to provide the give birth to this wonderful international academic society. Okay. Number three, SKKU is the only university which pay respect to Confucius, the Chinese philosopher. Do you know Confucius? Okay. 孔子 in Chinese. Okay. According to Kongzi or Confucius, there are three great pleasure in everyone's life. Number one is to have friends from far away and my home. So today is the day when I'm having one of the great pleasure mentioned by the Confucius. So I have many international friends or colleagues today here from United States, Professor Schubert, and Japan, and China, Japan with Professor Lee Hong-mo and Hoshika, and also from Vietnam, and also from Korea, many different areas and the district. Number two pleasure mentioned by the Confucius was the to study something every day. Is the one of the great three pleasure in the life. So today we are studying and learning about a very important topic, about the big data, AI, and the consumer finance. Okay. Number three, next pleasure is something else, which I'm not talking about today. Okay. And there is also great philosopher, which I know a bit, is the Immanuel Kant from Germany. To my understanding, Immanuel Kant enjoys having a seminar every week at his place. Okay. Whenever he had a meeting or a conference at his place, he always finishes the meeting with a great party, with beer and some snack. Okay. Today, we are going to have a great dinner after this conference. So I welcome all of you to dinner as well. Again, it's my great pleasure to have you all here. Please enjoy the great seminar hosted by Iafico, represented by Professor Cho. Okay. Thank you.
Thank you, Professor Chung. It's good to know Songyungan University and know more detail about like philosophers. So it's a little bit early, but we will start presentation session. The first presenter of today is Dr. Son Jae-hee. Dr. Son is a research fellow and economist at Korea Insurance Research Institute. The title of her presentation is Next Insurance, Digital Environment and Insurance Industry. Please, Dr. Son.
Hello, everyone. Thank you for inviting me to speaking. My name is Jae-hee Son from KIRI, the Korean Insurance Research Institute, and I'm quite nervous over here. Okay. Okay, today what I want to speak is digital environment and the insurance industry. Before start directly talk about the insurance industry, let me show you what I want to talk. First, I'm going to talk about the changes in digital environment and then financial industry first. And then turn into second chapter, I will talk about digital transformation in the insurance industry. And in this chapter, I'm going to talk about 5 changes in insurance industry. The first thing is insurance product and services. And second is insurance value chain. And then a third one is changes in value proposition. The fourth one would be the promoting insurance ecosystem. The last one would be the changes in the structure of competition. And then finally, I'm gonna make short implication, especially in this chapter, I'm gonna talk about the insurance consumer experience for MG generation. Okay, so changes digital environment and the financial industry. So what would be the key factors for digital environment? I would say, more as you all know, the first thing it would be the technology, clouding service or IoT. They are expanding the amount and the categories of data. And then also these technology help to develop of data analysis. So what about checking about the status of digital technologies, as I mentioned? So as you see the graph over here, the AI technology still play in second role, but not replace technology for humans. But it is already widely used in the various industries, such as product development, chatbot, and then image analysis judgment. And then right-hand side, as you can see the graph, the development and the connection of various IoT device plays a leading role in real-time data delivery and the production. And then IoT-based devices are expected in triple in 2030 compared to 2020. Back to these key factors of digital environment. The factors digital environment is not only the IT or data technology. As you know, we got through the COVID-19, and then also we saw the growth of MG generation. And then also I need to mention the deregulation for IT and then other industries convergence. So these factors affect the structure of industry and consumers. The structure of industry, this changes the business model. For instance, the redefine of value chain or the blurring industry boundaries. And then regarding consumer, actually it increases consumer expectations. For instance, the consumer expect convenience and the speediness is customized when they use and when they consume the product and services. So let's turn into the financial industry. So what is the effect of financial industry? The first one is the structure of financial industry. And then I would point out 2 things. One is expecting the role of non-financial companies. Actually, the non-financial companies have been having technology and the platform have been entered the financial market as well. And the second one is diversification of business organization. Actually, the financial company already expanding the collaboration with the external technology companies to increase their digital competitiveness. And then also financial company also start collaborating, makes the value chain fragmentation and then the diversification of their business organization. So these 2 things change to the structure of competition. So before, each individual companies compete each other. But after that, facing the change in digital environment, they face the more complex ecosystem oriented competition. And second one is product and services. Due to the accelerating of digitalization in the financial industry, the product and services are characterized three things. First, one is platformization, and the second one is super personalization. The last one is decentralization. This unbundling financial services and then promoting digital platform of financial industry, their services provided more customized by tech company, and that is a platformization. The second one is super personalization. Actually, this super personalization enhancing the welfare of financial consumers. For instance, eliminating time and space constraint of accessing financial services. That would be the convenience. And also it make personalized product and services based on experience and the behavior data. The last one is decentralization. Actually, with the development of a blockchain technology, the financial services would be separated from the existing financial system. That is what I thought about the digital environment changing in the financial industry. And then let's turn into the insurance industry. So this digital environment make insurance company to do digital transformation. And then what is the digital transformation? Digital transformation, it refers to continuous process of innovation, product, service, process, and operation through the various digital technology to improve the efficiency of company, and further to new digital-based business model that would be different from existing model. This digital transformation express two innovations. One is innovations in a way business is handled. For instance, digitalization of a work process to improve efficiency. The second innovation is the more important. It is in the happen business model. It is based on customer-centric product and services or the connectivity of ecosystem. And then what is the effect of these things, this digital transformation in the insurance industry? As I mentioned in the beginning, I would say 5 things. First one is a changing in product and services. The big data, improvement, AI analytics technology, and the expansion of a platform business changes the method of providing insurance services and expanding the scope of insurance industry. So these changes in insurance product services, I would say 2 parts. One is providing services to help you anticipate and alert and reduce the risk generation or the managing risk generation. So-called it is insurance as a service. Let me say about the example. Let's say the healthcare services based on wearable IoT health data, that would be the best example. Also, you also see the safe drive management based on the analysis of driving behavior data. There's the first thing. The second thing is these changes of product and services providing insurance products and services as much as measured risk. For instance, on the on-demand insurance, that would be a good example. So what I want to say over here is so far insurance product and services is provided when accident happened. But in the future, the insurance product and services would be risk management services based on the data, not just cover loss of accident. Second thing is change in value chain. The value chain of insurance services from risk acquisition to insurance payment provide ultra-personalized products and services that are automated and refined based on technology and data. As you see in the picture, currently what the insurance company do is the bottom line of this picture. This picture shows the 5 steps of value chain in insurance industry. The first one is product development, and the second one is sales. The third one is underwriting, and the first one is customer management, and the last one is claim. Each of the steps, what the current insurance company do is for product development, they do use the insurance statistic, just insurance statistic. For the sales, the insurance company focuses really highly on, depends on the offline agent channel. That's it. Third one, about the underwriting, they use 100% human underwriting and utilize only static data. That's it. And then what about the customer management? The current insurance company are really focusing on VIP customer. The last one, claim, they use the automatic the process of the claim, but it happened partially. But to be in the future, what change is the following. The product development, the insurance company will use behavior data. And then for the sales, it will be seamless connected with different channels. And then for the underwriting, it would be automatic underwriting and utilize various data. And first, about the customer management, the insurance company will provide preventive cares to all customers. And the last one, claim, it would be 100% automated process and improving fraud detection. How will it happen? It's because of data from the customers life cycle and customers life event data. It will help to insurance company to do these changes. Of course, these data from the customer have to be get some allowance from the customer. This one show regarding how change in insurance industry in the future regarding sales distribution channel. Then this one is the kind of the picture that how change in value chain regarding the claim. Well, let me quickly move on. The third one. The third one is changes in value proposition. The changes in the value chain that I explained before will also change the value proposition provided by insurance company. The customer would be more satisfied their consuming experience of insurance through new value from digitalized insurance services. So what is the value proposition of digital insurance? As you see the picture, I can say 4 value proposition. First one is flexibility of product and services. The second one is personalization. And third one is ambience. It is kind of consumer connect sales channel anytime and anywhere. The last one is seamlessness. Say the customer will experience the easy and quick underwriting based on dynamic pricing, and also they will and then claim process also would be done automatically. That would be the change in value proposition. Okay, move on first. And actually, these are more important. As a big data and a hyper connection between industry, the expansion of business area of big tech company, it forms various ecosystem and expand into ecosystem-oriented market. And then ecosystem-driven business and then companies are likely to emerge as a key player in the insurance industry. Actually, this promoting ecosystem connected with the last one, the change in structure of competition. Because of promoting ecosystem, the core competitiveness of players in the market will be changed. So as you see the picture, the core competitiveness, the originally capital and the risk management, that's it. But after that, it would added two more things. The one is digital and the technology, the other one is ecosystem. These core things makes change the structure of competition. I would imagine two possibilities. One is competitive collaboration with the big tech platforms and the insurance company. That would be happy things. But second one is the competitive advantage of big tech companies based on their technology and the data can be expected. So that would be not good for insurance company. Anyway, that is what I expect and what I imagine the how insurance industry will be changed because of digital transformation. So I make a short implication. So why do we pay attention to digital transformation? It's a rapidly evolving digital environment. If insurance companies follow existing growth strategy, then they may be eliminated from technology-based and consumer-centric market. In particular, growth of MG generation. MG generation demands fast and transparent information delivery and the differentiated experience. Because of that, it brings great worries to insurance companies. Before talk about things, let me show what is the status insured MG generation in the insurance industry. What you see over here is the graph, the status of insured customers. And at the bottom line, you can see the very different products that insurance company provide. And then this one is age of the insured customer. So as of March 2021, the result of examining the subscription status by insurance product. The most insurance except for travel insurance, the percentage of 30s of insured customer is only 15%. And then regarding 20s, it's much lower. And then it is not just these days, actually it happened for a long time. So this one is very makes worrisome to insurance companies. So what I want to say, insurance industry, what should it prepare? I want to make two things. The one is digital environment is both a crisis and new opportunity of insurance industry. And then insurance companies must first provide a new digital customer experience through changes in their view of insurance industry. That is the one thing. The second one is, as I mentioned, as I emphasized, promoting ecosystem, insurance company invest in the expanding the ecosystem and then collaborate with other industry to prepare to change in the competitive structures. And also secure use of data and then active solution to digital alliance issues will be needed. Regarding this, I want to focusing on digital experience for MG generation. We examine this the customer journey insured for MG generation. So what I want to show is following. So we made a survey, the entire journey of insurance consumption of MG generation. And then each process of MG generations, MG generations insurance consumption journey, we measure factors that cause satisfaction or dissatisfaction. The picture that you show is what I draw from this survey. So this one is focusing on when the MZ generation choose the offline channel. First, they start the search, and then after they decide to buy the insurance, and then when they face the accident, they make the claim. Through this experience, what they do is first, regarding research, because they choose offline channel, they have to make time in order to meeting the agent, and it's time consuming. So they having the bad experience, negative experience. But if the MZ generation met best agent, she or he make comparison of product, and then the MZ generation feel better. So having positive experience. And then this agent explain very well and easily, then this satisfaction is getting higher. But this agent try to push to buy the product, then the MZ generation feel bad, so have negative experience. So this experience is getting higher and then after a drop in the bottom. But when the agent explain or saying the reasonable recommendation, then their satisfaction is getting higher. So these pictures show how MZ generation feels about the consuming insurance through entire the journey of consuming. And then what I do is, this one is very, you can see very different reasons why they feel satisfaction or why they feel unsatisfaction. But it's very complicated to make the implications. So what I did is abstract insurance consumption satisfaction factors. This abstraction is based on the characteristic of MZ generation. So I made 5 factors, say that trust, the rationality, and the self-directionist, and the convenience, speediness. These 5 factors is connect with the items that I mentioned before, which affect satisfaction. And then that is what I make the connection. So before I show different factors that make the MZ generation satisfaction, the having positive experience or negative experience, and then I put it the abstraction like speediness, the self-direction or rationality. And then find what is most important factors for the MZ generation. That is kind of result of abstracting cause factors when the MZ generation choose offline channel. So in the insurance consumption journey through the offline channel, the main factors that increase the satisfaction of MZ generation are rational and self-directed. There is something very interesting that because I expect that the MZ generation really focusing on easiness or automation or convenience. That is main factors that I expect. But what I found is in the MZ generation, not just focusing on this easiness or convenience, they're really focusing on rationality and self-directedness. These 2 factors really affect their satisfaction. And then what about online? When the MZ generation choose online channel, then speediness and the convenience mainly affect satisfaction. Also, rationality is a very important factor for making the happy of MZ generation. So I mentioned 2 things, what insurance industry should do for changing digital environment, but focusing on providing digital customer experience, I mention one more. So what is the insurance consumption experience of MZ generation? According to the analysis that I showed you before, it is worth noting that the insurance consumption experience desired by digital generation is that insurance consumption that can reasonably judge it by themselves. As I mentioned, I expect MZ generation really focusing on easiness because they are digital generation. But no, regarding consuming the insurance, they really need rationality, and self-directedness. So I would say these were quite important key value to consider when desiring future digital insurance and the setting strategy in direction. In other words, digital technology and data in the digital insurance will provide satisfactory experience of MZ generation. In order to supporting consumer to the insurance consumption on their own direction. That is what I want to say. So that's it. That is what I want to say today here. Thank you for hearing. And then I would expect valuable comments from you guys. Thank you.
Thank you, Dr. Son. We have distinguished guests online. We are very honored to have Professor Daniel Schwartz from Minnesota. Professor Schwartz, can you hear me?
Yep, I can hear you. You can all hear me okay?
Yes. Dr. Schwartz is Frederickson and Bayer Professor of Law from University of Minnesota. Professor Schwartz is an award-winning teacher and scholar. In particular, his book, Insurance Law and Regulation, has been used as the principal text in courses on insurance law in more than 100 American law schools. Please join me welcoming Professor Schwartz.
Thanks so much. Now, I'm going to try to share my screen.
Okay.
So hopefully that will work. Let's see here. Okay, great.
Okay. I can see your slide now.
There
Okay.
we go. And we'll try. All right.
Great.
Look good?
Yes, it's good.
Well,
Thank you.
Well, let me just start off by thanking you for inviting me. And although it's the middle of the night, I'm very excited to be here. So I'm going to talk about a paper that I wrote a couple years ago, but that I've been working on and presenting to a lot of insurance regulators in the US. And it's called Proxy Discrimination in the Age of Artificial Intelligence and Big Data. And I guess I want to sort of start my comments by noting that while I absolutely agree with the prior speaker that there is a tremendous amount of potential for AI to really promote broader insurance markets, more efficient insurance markets that can serve consumers better, my paper really is going to focus on the costs, or at least the risks of using AI in insurance. And part of that stems from my orientation as a law professor, because of course, law and regulation principally need to be concerned about potential problems arising from markets. If markets are just going to do great things, then in general, the attitude is, well, let's just get out of the way and allow for markets to flourish. Maybe we'll try to facilitate that, but in general, there's much less of a role for law and regulation when we think the trajectory of the technology is unambiguously positive. So what I'm going to discuss are potential concerns that may warrant legal interventions. So with that, let me just give you an overview of how I'm going to present this. So what I'm going to do first is talk for a bit about how insurance discrimination is regulated in the United States. And so we're going to be focusing mostly on insurance underwriting and rating. When are insurers allowed to charge different rates to consumers based on their characteristics, and what are the legal constraints on insurers in that setting, and why do they exist? once we have that framework, and I'll try to talk about some features of that framework that may apply outside of the US setting, but of course, I'll be very interested to hear whether there are analogous concerns in other countries, in Korea in particular, and in other countries that are represented in this seminar. What I'm going to do is talk about, okay, why does AI fundamentally represent a challenge to this regime? Why can't we just apply the law as it has evolved and sort of say, well, it's the same basic set of systems? And so the question is, okay, what does AI do that potentially problematizes our legal and regulatory approach? Having done that, the third part of my talk was, okay, what do we do about that? And the answer I'm going to give is, what we need to do is to reconceptualize this idea of proxy discrimination. And I'll say that in the US, there's been a pretty broad movement, and I like to think I helped contribute that, towards agreeing that we don't want AIs to proxy discriminate. Unfortunately, there's been less unanimity about exactly what that means. So I'm going to be as precise as possible about how I think that should be defined and then enforced. Okay, so with that background, let's get started. So the traditional way in which insurance is regulated in the United States is that there are prohibitions on what are called unfair discrimination. And that's in the statutory rules that apply to insurance companies. And in general, what this means is that if an insurer wants to charge more to someone, they have to show that there's actually some reason for believing that that person is riskier. So what an insurer can't do is charge more to someone because they believe that person's willing to pay more, right? You actually have to have a cost-based justification in the United States for charging more to specific consumers. Now, that sort of approach is one that I don't know if it's universal. In fact, I think that I know that there are certain jurisdictions like the UK where that is not the rule. But in the US, we also have this other element that I do think is pretty common, although how explicit it is varies. And that second limitation is that insurers can't discriminate in terms of pricing, in terms of the coverage they offer, in terms of their willingness to offer coverage, based on certain suspect characteristics. And those suspect characteristics, they vary by line of coverage, and they also actually vary by state in the United States. So it's very hard to generalize because we have 50 different insurance jurisdictions, and each one varies it based on whether we're talking about auto insurance or health insurance or what have you. But in general, there are, here is a sampling of the types of restrictions we have on when insurers can discriminate. So they can't charge more on the basis of race. Health insurers can't charge more to people who have a history of pre-existing conditions. They can't charge more to people who maybe have a genetic mutation, like the BRCA2 mutation. And so there's sort of this universal set of rules, and this is sort of a really fundamental element of insurance regulation. I want you to notice something about this before we move on, this regime. The first thing to notice is that the way that these laws are structured, what is prohibited here is the use of certain factors, even if they are predictive of risk. And actually, in a lot of these cases, some of these factors are very predictive of risk. So if you think about health insurance, of course, your history of having pre-existing conditions is predictive of whether or not you're going to incur future claims. But we nonetheless prohibit the use of that. Race happens to be quite predictive of claims like in life insurance. For instance, African Americans in the United States do have a significantly lower life expectancy, even when we try to take into account other factors, than non-minorities. And so what we do with these laws is we say, look, we're prohibiting insurers from using these factors, even if they're predictive of risk. So we're doing something really different here than we do here. Now, why would we do that? The answer is because there are concerns at play that are larger than the insurance industry. So for instance, in the US, the way that we ensure people have access to healthcare is by making sure they have access to affordable health insurance. And if we allow health insurers to charge more to individuals who have a history of cancer, say, that can actually mean that people who have pre-existing conditions can't even access healthcare. And so because we have this really important goal of facilitating healthcare, we prohibit discrimination in this way. Similarly, I'll take this example, but to me, it's a really sort of salient one. It turns out that women who have been victimized by domestic violence are at much higher risk of making a property insurance claim. And the reason for that is that there's a very unfortunate tendency for men who abuse women to also light the family house on fire. And that results in an insurance claim. This is sort of a very well-documented phenomenon. And so property insurers might say, well, gee, we want to charge more to people who have reported being victims of domestic violence because they're more at risk of making a claim. They're riskier. But we prohibit insurers from doing that for a variety of reasons. But perhaps the most intuitive is we don't want to discourage people who are victimized by domestic violence to make a claim to the police department because they're concerned about what will happen to their insurance rates. Or similarly, and maybe perhaps more intuitively for some of you, we don't want to charge more for health insurance to someone who has a genetic condition because they might not get a genetic test. And we want people to get genetic tests without worrying about the insurance implications of that. So we have this regime that limits discrimination, even when that discrimination might be actuarially justified because of larger social concerns. Now, another final piece of sort of the existing regulatory scheme in the United States that I want to highlight is we also have prohibitions, although they're usually implicit, on what are known as redlining or intentional proxy discrimination. So it's very clear that insurers can't charge more to people who are African American than who are white, even if they can show that people who are African American are more likely to have claims. But what insurers in the US historically did is they engaged in what is known as redlining. And so they'd say, oh, well, we're just going to charge more to people who live in this area, which is predominantly African American, than to people who live in this area, which is predominantly white. And it was quite clear that they were essentially trying to circumvent rules regarding discrimination on the basis of race by selecting variables that didn't explicitly use race, but that were specifically designed to correlate with race. And so there was a series of precedents that held insurers liable who did this and said, look, this is essentially the same thing as intentionally discriminating on the basis of race, if you're intentionally discriminating on the basis of some factor that's related to race. So these rules over here are really meant to enforce these rules. So this is the regime we had and have had for decades in the United States. Let me say one thing before I move on, because again, I'm not actually sure how many explicit prohibitions on discrimination exist in other countries. I'm familiar with some countries. Frankly, I'm not familiar with Korea in this regard. But one thing I want to note is that it may very well be in many countries that there's not an explicit prohibition on the use of certain factors because insurers don't use those factors, right? So for instance, it very well may be in many countries that women who are victimized by domestic abuse are more likely to have insurance claims. And that if an insurer ever decided to ask you, or to look at police reports and say, well, have you been the victim of domestic abuse? If so, we're going to charge you 20% more, that would create backlash and then lead to a law prohibiting that type of behavior. So the mere fact that there doesn't exist laws that restrict certain types of discrimination doesn't mean that any discrimination goes. It just means that at the end of the day, insurers haven't done are used certain factors that would obviously cause backlash among regulators or among consumers if it were discovered. Okay. All right. So with that base, the next question we need to ask is, okay, well, what's different about AI? Why does AI create a problem in this arena? You'll oftentimes hear people complain about AI as creating unfair discrimination, and they'll sort of make vague assertions of this, or it's unfair, but you oftentimes don't hear a lot of specificity or, frankly, clarity of thought regarding why. So I want to start with this idea that I describe as unintentional proxy discrimination by AI. And just to go back over here, you'll remember intentional proxy discrimination. That's the idea that I want to discriminate on the basis of something where I'm not allowed to do so, on the basis of race or genetics. So I intentionally choose something that correlates with it. I intentionally choose where you live because there's segregation, okay? But what AI inevitably does is it actually produces unintentional proxy discrimination. So what do I mean by that? So the first thing to understand is, okay, well, what does AI even mean? And here I'm going to be talking about machine learning AIs, right? Well, what a machine learning AI does that's really unique is that it's not programmed based on some intuition about causal mechanisms, which is frankly how insurance has historically always worked. Oh, we think people who have more accidents are more likely to get, or more speeding tickets are more likely to get into accidents. So we'll look and see if there's a correlation, and if so, we'll charge you more. So it starts with intuition about causal pathways. The way machine learning AIs operate is you just say, look, here is my goal. My goal is to predict how likely it is that someone's going to have a loss that's covered. And I want to minimize, how many, the expected losses of my policyholders. And then to achieve that, I'm going to give this machine lots of historic big data that includes all sorts of information about individuals, but also includes, for the training data at least, the actual insured losses that they incurred. And what the machine learning algorithm does is essentially figure out on its own, without any human intuition intervening, what factors correlate with the target variable, and then it produces a model, and there are a lot of different ways of doing this, that predicts that based upon all of these factors for future cases. And so there's never any intuition that enters into it about what's going on. It just finds, oftentimes hundreds or thousands of different variables that in the training data predict claims, and then it uses that method to predict claims in the future. Okay, so with that basic understanding laid out, let's think about why unintentional proxy discrimination is such a problem. The problem exists because you'll remember, I told you earlier that the goal of law, at least to come back over here, the goal of these laws is to prohibit insurers from discriminating on factors, even though they're predictive of claims, right? Even though health is predictive of claims, health insurers can't discriminate. Even though genetics is predictive of claims, life insurers can't discriminate. Even though domestic violence is predictive of claims, property insurers can't discriminate, because we care about larger things. The problem is that the nature of a machine learning AI is that there's no way to prevent that machine learning AI from attempting, and I'll put that in air quotes because of course it's not conscious, but from, in a sense, attempting to capture the predictive power of information that it's not supplied with. So the traditional way that you would try to effectuate the goals of the law that we described over here is you just wouldn't give the AI training data about race. You wouldn't give it training data about domestic violence or health, right? You would omit that information from the information on which the AI was being trained. The problem with that is the AI has reams of other information, including, social media usage and Netflix viewing habits, all, there are all these big data intermediaries that make this data available. And to the extent that there is some factor that helps predict claims that's not captured in that data, then the AI will essentially deduce that correlates with those prohibited characteristics are predictive of claims and use those correlates. So let's take an example of how this works, okay? Let's imagine, right, that we have a property insurer. And the property insurer says, look, I just want to predict how likely it is that my policyholders are going to make a claim. And AI, I want you to do that. Here's lots of data about all of these people for training purposes that you can use to build your model, but we're not going to give you domestic violence history, of course, because that's not allowed by law. Well, domestic violence history, as I told you, is statistically correlated with property insurance claims, very highly so, right? You're at a much greater risk of making a property insurance claim if you've been victimized by domestic violence in the past. So what will happen in this machine learning program? To the extent there's anything in the data that is correlated with domestic violence, the machine learning algorithm will latch onto that data. Perhaps you are on a Facebook group, survivors of domestic violence, that is contained in the data. That will be predictive for the machine learning algorithm. Perhaps you've visited a police department or a women's shelter where they help, and that geolocation data is in the big data. The AI will use that data because it will predict claims. And so at the limit, there's actually no way to use machine learning AIs and prevent them from finding correlates to characteristics that are predictive, even if we deprive the AI of information regarding that information, information regarding those traits. And so you can't actually prevent an AI from doing that, at least if the AI has enough data, because any data that correlates with that suspect characteristic will be used. I mean, again, we can sort of use let's think about genetics. Life insurers are not allowed to use genetics because we want people to get genetic tests. Well, what will life insurance AI do? It will use, for instance, social media information. If you say liked a support group for people who have a certain mutation, or if you saw a particular doctor who specializes in that, or if someone who's in your family on Facebook reported that they have that genetic condition, all that information or any of that information would then be predictive of claims and harnessed by the AI. And so at the end of the day, the real problem that is unique to AI is that the proxy discrimination, or the discrimination we try to prevent here, we try to say these things are predictive of claims, but you still can't use them, it becomes impossible. And not only does it become impossible, but unlike the intentional proxy discrimination that only occurs when we have bad actors that are trying to exploit the law, AIs inevitably do this type of proxy discrimination, even if no one knows they're doing it, and we try to stop them. They're not evil. They're not trying to circumvent the law. They're just trying to predict the thing you told them to predict. And they're going to use any information that's predictive without asking, hey, wait, why is that predictive? And so we've already gone over this example, but let's just appreciate how big a problem this is. I mean, people are not gonna, again, I come at this from an American perspective. I don't know how universal this is, but people are not going to feel like they can get genetic tests that they might need to get appropriate medical care if that's going to result in their insurance increasing. People are not going to report domestic violence if they, or at least they'll be less likely to do so, if they feel like that means they're going to lose their insurance. People may be reluctant to get health care if they believe that that's going to result in their health insurance increasing. So this is a fundamental problem given the legal regime that exists in the United States. And it's a fundamental problem that's specific to machine learning AI that almost inevitably results as insurers try to use these tools to price and underwrite. So the question was, well, what do we do? What do we do? Because if we go back to these tools over here, and we look at the way that they're structured, everything that I've described actually doesn't seem to fall under any of these categories, right? I mean, clearly, the AI in general isn't going to use factors that are not predictive. I mean, AIs are really good at choosing factors because they predict the target variable. So that's not an issue. We're not explicitly using any of these factors. We're not providing the AI with race or with sexual abuse history or anything like that. So there's not explicit use of those factors. And there's also not any intentional proxy discrimination, because this occurs even if no one knows it's happening, right? The programmer might not know what's happening. The AI, unless it's like, we think it's conscious. And, you know, despite the claims of one Google researcher that you may have read about, I think most people agree that AIs are not conscious. They don't have an intent. They're not trying to do this. And even if that's, you know, theoretically possible in some contexts, clearly the AIs that insurers would be using are not conscious in that way. So in a sense, what AI does is it fundamentally undermines the purpose of the law in a way that actually technically seems to comply with the law. That's the puzzle. That's the problem. What do we do about it? If we just accept it, we have these pretty intolerable results. And I'll just note this, the results are not only intolerable in terms of how we think regulation should work, but I think they're actually also intolerable for the insurance industry. Because if you think about insurers trying to leverage all of the benefits of AI that we've heard about, and then stories coming out about, well, I was denied insurance because I reported that I was victimized by domestic violence. I was denied insurance because I have a genetic condition. What's going to happen is there will be backlash against insurers, and the result will oftentimes be sort of this extreme response of, well, you can't use AI at all, notwithstanding the benefits. So to me, this is a pretty fundamental problem, not only for regulators and lawyers, but for insurers too, because of the potential for these types of results to become public to the extent insurers are relying on AI. Okay, so what do we do about it? How do we deal with this problem? So this is where, you know, people are really struggling in the United States, across the globe. And this is sort of where I've, you know, right now I'm going beyond sort of, you know, identifying the problem, saying, here's what I think the solution is. And I'll just sort of say, you know, the way I've been thinking about it has gained a lot of traction in the United States. Whether or not it's actually implemented in law is, you know, we're still waiting to see. But I would say that there's a lot of support for the approach that I'm advocating for. So the first thing we have to do is sort of define a new category of what is prohibited or what we want to prohibit. And the way that I think about this is there needs to be two things happening in order to really focus in on the problem that I'm identifying. First, we have to have what's known as a disparate impact. Okay, so the basic idea here is that members of a protected group are basically harmed in some concrete way by the use of an algorithm. So, you know, African Americans are charged more for insurance because an insurer uses an AI. Victims of domestic violence are charged more for insurance because an insurer uses an AI. So that's the first requirement. But and that's actually a very familiar concept in American law, disparate impact, but it's very controversial in insurance. If you just say, well, that in and of itself means that we might not have insurance, we might, you know, an AI model might be suspect, because of course, insurers have to discriminate on the basis of risk-based characteristics. And oftentimes that will disproportionately affects some groups as opposed to others. And so if you say every time you discriminate, we have to run through this test, you actually run the risk of undermining risk-based pricing much more broadly. So in my view, there has to be a second condition in order for the law to intervene. Not only must members of a protected group be adversely affected by the AI, the use of AI, but it must be that the AI is using a facially neutral trait whose predictive power derives from its correlation with a prohibited characteristic. So let me say that again. It must be that the insurer is using its ultimate model that the AI produces, includes a factor, and the reason that factor is useful in predicting the target variable is because it correlates with a suspect characteristic. So to go back to some of the examples we used, right? An insurer would not be able to use an AI that produced a model that relied on geolocation data regarding domestic violence, or that relied on social media data that included some information about your genetics, or that relied on geographic data that was correlated with race, if the reason why the AI used that was because of that correlation. So the reason why it makes sense in my mind to really target this type of discrimination and to define what is legally problematic, or we might just think about it as ethically problematic in this way, is we're not just saying you can't discriminate if it harms protected groups. That's way too broad. But we're saying if the only reason why some factor is being picked out by your AI is because it correlates with a suspect, that is akin to intentional discrimination, intentional redlining. It's essentially the modern version of redlining. The only reason that insurers use geography with redlining was because they wanted to discriminate against African Americans, but they couldn't do so explicitly. Similarly, if the only reason the AI is using some social media information is because it essentially includes implicitly information that they wouldn't otherwise be able to use, that is effectively redlining. It's effectively proxy discrimination, even though there's no intentionality there. Now, the next question is, okay, let's say that you're with me so far on sort of theoretically that makes sense. Okay, the question is practically, how do you do this? How do you do this, right? It's not an easy thing to do. But it turns out there actually are some pretty practical tests for figuring this out. So for those of you who are, I know there are some economists in the room, right? But there are statisticians. The easy way to think about this is as follows. If you have a multivariate statistical model that includes all of the characteristics, does one of those characteristics that you're relying on cease to become predictive if you actually include in the model the suspect characteristic? In other words, it's omitted variable bias, right? If the predictive power or the statistical significance of any of the variables you're relying on is eliminated if you include a prohibited characteristic, the implication is the only reason why that variable that was facially neutral was being used in the first place was because of its correlation with the prohibited characteristic. There's even a simpler way of doing it, though, which is to say, well, let's say we're only looking at a homogeneous group of policyholders with respect to the legally suspect variable. So let's say we're only looking at white policyholders. Does this factor that normally you're using to predict risk suddenly disappear in terms of its predictive power? If so, the implication is that the only reason that characteristic was predictive was because it differentiated between people on the basis of race. So you can actually have some relatively simple tests, at least in theory, for identifying this. Now, admittedly, it actually becomes more complicated if your AI is developing nonlinear models, in which case there are some more advanced methodologies to use. But at the end of the day, the basic idea is, look, if the only reason that a characteristic is being used by an insurer is because it correlates with some other characteristic that they're not allowed to use, that's unlawful. Now, why is this beneficial? Well, in my mind, what this test does is it offers a practical way forward. It offers a way forward where we can use AI to better price risk. We can use AI to achieve many of the benefits that we've heard, but we can do so in a way that respects the historic goals of anti-discrimination law in the United States and in other jurisdictions. And again, to the extent there aren't laws there, you can think about it as ethical restrictions, right? If AI is charging more to some people than other people based on their ethnicity, we wouldn't, I assume that would be a problem legally or reputationally or ethically if an insurer were doing that explicitly. So should we allow insurers to do that implicitly through AIs? That to me is troubling, sort of whatever your underlying legal or regulatory regime is. At the same time, this actually, in my mind, promotes the use of AI by allowing insurers to use AI robustly to predict risk, while at the same time avoiding some of the potential negative consequences that we discussed, right? They can rest assured that if there's some controversy that comes out, oh, this insurer is charging more to these types of people as opposed to those types of people, and that becomes, they can say, well, look, we have tests for that. Here's what we do. And to the extent that we need to alter those tests or we need to think about what are the suspect variables differently, we have a way of doing that. And so this allows AIs to move forward in a way that actually, I think, maximizes their potential to remain as a stable and useful technology. So the final point is, in my view, the framework I've given you here and that I've discussed and that I've been sort of discussing in the US to various different audiences provides a lot more analytical clarity than other models. You see other people say, well, AI is discriminating in unfortunate ways, or they're not fair, they're not transparent. But then a lot of times you start losing analytical clarity when you start thinking, okay, well, how do I know if this is unfair? What do we mean? And this is a big problem in the United States right now, where lots of insurance regulators have said, yes, we don't want AIs to proxy discriminate. And then no one knows what proxy discrimination means. So to have analytical clarity here, just so we can decide what is permitted and what is not permitted, is itself hugely valuable in my view. So those are my points. Of course, I invite any of you who are intrigued by this to read my paper, which goes into substantially more detail on this, and I look forward to the conversation moving forward. The other thing I'll just say preemptively is I'm hoping to stay on this until the end of the conference, but that would leave me awake till 3 a.m. So if to the extent I need to sign off early, it is not because I am not enjoying myself. It is simply because my coffee has worn off. But I really appreciate the opportunity to discuss these ideas with you. So thank you very much.
Well, thank you. I would like to thank you to Professor Schwartz sharing his insightful idea. Well, we have panel discussion, but we found that there is such a big time difference from Minnesota and Asian country. So do you mind if we receive some questions from audience? It could be online or offline. Anyone, please? Yes. You can come to front of the, okay.
I can't hear anything.
She is with us and will come to the front of the room. Professor Park Soyoung, Kim Soyoung, Park Soyoung from Seoul National, from the Seoul National University. Sorry.
Okay, thank you very much. It was my very great pleasure to see your presentation. Can you hear me now?
Yes, absolutely.
Okay. So it was really great. I mean, I also had a very vague idea about this proxy, discrimination, but it was great to hear your presentation. So now I'm much better. I mean, it was much, better clarified now. But while listening to your presentation, I had this question about what really is a problematic discrimination. So, for example, those, even if predictable, we ban using these social, factors such as domestic violence or this race, right? But I think in some sense, this domestic violence and race type of factors can be different. I mean, there can be two different type of socially discriminative factors in a sense that the domestic violence or cancer is actually, we want to ban using those things because it will, as we have mentioned, that it will probably prevent or, make people to hesitate, reporting these things and do not want to get genetic tests. So it kind of causes a certain, some sort of behavior on not very good behavior. So we definitely not want to use these things. And also specifically, we are probably mentioning that we are willing to subsidize those high risk people. Even though you have cancer in our society, we think it's okay to subsidize those people by pulling them together. So that I get it. And for those factors, you definitely do not want to discriminate them, even using proxy variables. But on the other hand, when it comes to, say, race or religion, as far as I know, I understand the reason why we ban using, race or religion stuff, although they have a statistical correlation between risks, is that it's unclear what is the causal relationship, right? So, like, if African Americans, they have a high risk, but we do not want to penalize them because of the fact they are born with that skin, right? So, so we do not want to discriminate them because there is no clear causal relationship. But for these factors, somehow how it is different is now this machine learning or data analytics probably can directly show the correlation that the behavior that causes the accident. Right? So, but that behavior probably is somehow associated with, certain race or religion. And even if we are simply using that, behavior, at the end of the day, that result, that ML, machine learning score may have a strong positive correlation with certain traits like race, right? Then do we want to subsidize very rich, aggressive African American because they are, that race?
Yeah.
Are you following me? So,
yeah.
Yes, so I think there maybe, there can be two different, this discriminative, some sort of factors. And if it is really the second type, just because of the fact that the scores have some sort of correlation with the traditionally predicted, protected traits, do we still protect those traits or not? Of course, that there can be two different type of traits. That's why I brought up this a screen. Let me show you. I actually put this thing together while I was listening to your presentation. Can you see this?
I can, yeah.
So this is the score that I have mentioned that may have association with high risk or low risk, but there can be also some other factors that is specifically designed to predict certain trait. So if certain trait simply predict which race you are, I think that's wrong. But if there's some other algorithm that somehow has great predictive power for that behavior itself, but happen to correlate with that trait, do we still want to ban them? Like, what's your opinion on that? I don't know. It's kind of complicated. I don't know whether we're.
No, it's very complicated. This is a really good question. I've heard a few different points here, so let me try my best to
Okay.
respond. So, and I'll say that I think we deal with some of these issues in the paper. So we actually go through some of this, but you're right. The easiest case is when we have a factor where there's a direct causal link between that factor and risk. And even though there's that direct causal link, we still don't want you to use it. So like genetics is the easiest. Actually, that's why Anya Prince is my co-author, because she actually studies genetic discrimination. And to me, that was the most intuitive example. I also think domestic violence is a very intuitive example. Now, race is much more complicated. And race is much more complicated because even though race oftentimes is very predictive of risk, it's very unclear why. And it might be that at least for some reasons, we might be okay with a factor that correlates with race. So let me actually not use race and use religion, because I think this is actually a really good example. So I'm Jewish, okay? Now Jews, what we do is we light candles all the time. Like every holiday, we light candles, okay? So you might say Jews are more at risk of fires because we light candles all the time. Now, should an insurer be allowed to charge more to Jews? What I would say is they should be allowed to charge more to people who light candles, right? And if that disproportionately affects Jews, that's fine, right? Like there's no problem. On the other hand, if they're just saying, well, if you're a Jew, we're just going to assume you light candles. If not, we're not going to look into it. That's a problem. So the difficulty is, how do we disentangle the use of factors that correlate with a factor that is predictive for reasons that are bad or for reasons that are good? And what I would say to that is, there's actually not much risk of proxy discrimination if the causal pathway is race or religion correlates with some factor like lighting candles, which correlates with risk. Because in that case, what the AI will do is it'll just go directly to the source in a way, right? So let's take the example of Jews and lighting candles. You might say, oh, well, gee, we should be concerned that AI, machine learning AIs are going to charge more to Jews because we light candles all the time. And so it's going to proxy for Jews. And even though, in the training data, it won't know who's Jewish and who's not, we'll look at things like, who I'm friends on Facebook with. And if I, like my synagogue, it'll charge me more. I actually don't think that's much of a concern. Why? Because if the underlying behavior is lighting candles, they're actually much better proxies for whether you light candles than whether you're Jewish. Frankly, most Jews don't light candles at all. It's only like a subset of relatively religious Jews that do so. And probably there are much better proxies for that. Like there might even be just direct data about like who lights candles, right? It might be that like every time, there are people who order candles all the time. And so it just charges more to people who order candles or who order, lighters. And so if the causal pathway, if there's some clear risk-related activity between the prohibited characteristic and the risk, proxy discrimination isn't much of a concern, because the AI, as it gets better, will just go directly to the causal pathway just because it's more predictive. Where it becomes a concern is where a factor is predictive in ways that can't be explained with some neutral characteristic, right? So the difficulty with race, and this is a huge issue just in America in particular, because of our legacy of slavery, of course, is it turns out race is predictive of risk, even if you include everything else you think you can include, right? So well, of course, race is predictive of risk because of income, and there's a huge disparity in income. So include income. Race is still predictive. Oh, well, it's education. Okay, we'll include education. It's very hard in many models, and it depends on the data set, it depends on the context, but it's very hard in many models to basically eliminate the predictive character of race by including non-neutral characteristics. Now, the question is why? So let me give another example. Let's take auto insurance. Auto insurance, African Americans have higher claims. They're there are a lot of ways we can try to explain that. There are income-based reasons. But what if the reason why African Americans have higher claims is because people discriminate against African Americans? And if you're in a car accident, if a white person is in a car accident with an African American, they're more likely to sue them because they just don't like African Americans as much. Okay. So in that case, there's a direct causal connection between being an African American and having higher insurance rates. In that case, the model will inevitably proxy discriminate for African Americans because there's no other neutral characteristic that is intermediating that relationship. And that's where the problem really arises. And so, because that's where the problem arises, the way that I think about proxy discrimination is not only, it will only be a concern when there is either a causal pathway or there's some pathway between the prohibited characteristic and the and risk of the target variable that is intermediated by something that's not observed in the data. And in those situations, I think we really do have an ethical problem. Now, when do you say that's an ethical problem? That's a harder question, right? And I think that will vary by country, right? I mean, race is such a big issue in America. It may not be as big of an issue in other countries, right? But you may have your own issues. I'm sure, you know, every country has its own issues, right? Where there are real problems with discrimination. And again, what I would say is there are going to be forms of discrimination that we don't want insurers to engage in, whether or not that is found in the law, because oftentimes, essentially, historically, insurers wouldn't have used those factors because norms, right? And so there wasn't a need for a law. But essentially, there becomes an absolute need to say, here are the things we don't want you to do once we're using AI machine learning, because inevitably they're going to do it otherwise if it's predictive. So hopefully that answers some of your questions. I'm not sure if it answers all of them, but hopefully it gets to some.
Yeah,
and I actually
helped a lot. Thank you so much for a nice presentation and the answer. Thank you.
Thank you, Professor Park Seo-jung. Well, I have to blame my broad type. I'm not really good at memorizing people's name, especially at a conference. We have another question. I've got an instant message. Your presentation was very insightful, and thanks a lot. Suppose that a statistical ground between a prohibited factor and some X variables is well established. Do you think that information should be used differently in both underwriting and risk-based pricing? The latter may be more difficult. For example, a 10 basis point difference is a big enough difference to discriminate.
Yeah. So this is an issue that comes up a fair bit in the law. Some laws in the US will prohibit the use of underwriting. So say you can't refuse to issue a policy, but you can charge more. In my mind, it doesn't ever make sense to differentiate between the two, because at the end of the day, they bleed into each other. I mean, look, if you're going to charge 100 times more for insurance, you're effectively just refusing to insure. And actually, the way that insurers increasingly, and again, this, I don't know how universal this is, but the United States, nowadays, a lot of underwriting is just meant to facilitate rating. So a lot of times what insurers will do is they'll have 20 different companies, okay? And they'll underwrite you into one of the different 20 companies, each of which has a different rating plan. And so the distinction between underwriting and rating, underwriting is whether you insure or not, rating is what price, to me actually is much more fluid and harder to define. And for that reason, it doesn't make sense to try to prohibit discrimination in one domain as opposed to the other. If you're going to say you can't use that factor, don't allow it in either. If you're going to say you can use that factor, allow it in both. So that's how I would think about that, but it can be a difficult issue.
Well, I checked the Minnesota time. It's 1 a.m. It's 5 after 1 a.m., right?
That's right. That's right. But I'm still going. I'm all right. I'll stay on and well, I can't promise I'll stay to the end.
Thank you for your time and your insightful presentation.
Thank you.
We have the last presentation. The last presenter is Dr. Kim Young-il from NICE Investors Services. The title that he presents is The Impact of Alternative Data in the Market for Consumer Credit. 천천히.
Thank you for giving me this opportunity to talk about credit market. I'm actually in NICE Information Service, which is more like a credit bureau in the US, and also do some scoring, produce some scoring services for consumers.
We have
Yeah.
to share our 공유 중지를 하고 다시 화면 공유하고 이거죠. 그럼 지금 네.
Yeah. So the topic of my presentation is the impact of alternative data in the market for consumer credit. So these are the contents through which I'm going through. Background and overseas and domestic trends, and then I'm gonna show you some results of how alternative data affect financial accessibility and risk management, and then conclude. Just to begin, this is a well-known information asymmetry problem. In credit market, we have a supplier of credit and the demand side for credit. So, but as you know, there's an information asymmetry between creditor and debtors. Because of the information asymmetry, we may have a few problems, such as well-known adverse selection and moral hazard. As you may know, adverse selection is a problem when there's a informational asymmetry between creditor and debtors. The creditors do not know, because creditors may do not know the risk characteristics of debtors. They may oversupply credit to debtors with a high default rates, or undersupply to credit to low risk debtors. So they may incur market failure. And moral hazard is an issue that after loans are made, debtors may not have enough incentive to repay their debt. So because of these two, adverse selection and moral hazard problems, market oftentimes fail. So because to solve this problem in credit market, we have established some credit information sharing system. So with this credit information sharing system, now creditors may have more information to assess more correctly the risk of debtors. So those problems might be somehow reduced. And then we may ask what types of credit information are used in the credit market for credit allocation. The first one we can think of is negative information, which is often used negatively for credit scoring, such as default and delinquent information. As more credit information is accumulated, positive information began to be accumulated, which
such as loan repayment performance, credit card usage information. And now, as we have discussed today, we got a big data, not just credit information. But also we have a lot of different kinds of alternative data, such as utilities, telecommunication, this commerce, SNS, and etc. So, as we have more information, more kinds of information, we can have more risk differentiation across debtors. So as a result, now financial institutions now can increase, can take more potential borrowers in the credit market, while the delinquency rate decline. So in terms of more potential borrowers now enter the credit market, while the risk of the total portfolio is now lower. So in that sense, we can say that we may have some improvement in terms of social welfare. I may cover that issue later again. So what kind of alternative data have been collected and used by what kind of companies and which countries? As you may know, there are global credit bureau companies which have collected alternative data to improve so-called simple consumers financial accessibility. In the early 2000s, alternative data began to be used as a supplement as issues of like polarization of financial services and financial access limitation of simple customers were raised in the existing credit scoring system that use financial information on it. So global cities such as Equifax, Experian, TransUnion collected information by partnering with Anwar, acquiring companies that have alternative data, and reflect those alternative data on their personal credit reports and credit scores. So what kind of information were collected, such as telecommunication, energy, utility payments, and rent payment, salary, subscription services fees, and recently BNPL, which is short for buy now and pay later information. So by using this various kinds of alternative data, they provide those information to financial institutions so for them to better risk differentiate across different financial consumers. And also there's a special case of China, which has used from the very beginning alternative data due to the absence of database. As you know, China didn't have a much well-developed banking system even in early 2000. So they had to use some different kinds of information, such as e-commerce information. For example, Alibaba established a CB company called Zhema Credit. They use alternative data such as commerce information and use them for credit scoring. So the case might be somehow different than some other advanced countries in terms of how they produce consumer credit scoring. And also nowadays there are many kinds of fintech companies which use alternative data to expand the power of credit scoring. They use all kinds of collect all kinds of information, such as social media activity information and mobile phone usage information and psychological analysis information and so on. So since globally alternative data quite comprehensively utilized, in Korea we also had some institutional change. In 2018, there has been a policy announcement which is called, which might be translated into a comprehensive plan for data utilization and information protection in the financial field. So which was announced to activate big data utilization and also to strengthen competitiveness of the data industry and also to enhance information protection. And then we also had some new institutional settings, which, for example, designated agent and innovative financial services, so-called sandbox. By using this new institutional settings now, and also plus there has been issuing of small licenses. By using this. These new institutional settings, now we can collect alternative data to score for the purpose of credit scoring, which wasn't quite easy before 2018 or before 2000 when there was amendments to the data laws. So globally, as well as domestically, there has been a trend of using, collecting and utilizing alternative data for better risk assessments, which may contribute to financial inclusion as well. So here I do some data analysis to figure out how effective the alternative data in terms of financial accessibility and risk assessment. So what kind of information might be used? Here I use some telecommunication information, commerce information, and mobile payment information. As you may know, most Koreans use a telecommunication service nowadays. So we can collect a subscription, some mobile communication subscription information, product information, billing information, receipt on pay information, and etc. And because most Koreans use these three mobile companies, if we have information from these three companies, we can cover most Koreans, of course, economically active people. And using telecommunication companies, we can now in a position to risk assess those people on a somehow equal basis, which wasn't quite easy before. And also here I use commerce information, which could be online data or offline commerce data. So by using commerce data, we can also use them for the purpose of credit as and also there's a information from mobile payment service such as basic transaction details generated during the mobile payment process and limits imposed by telecommunication companies payment information on purchase products and etc. So by using those information, we can improve the prediction power in terms of risk assessment. So how can those alternative data might be used in credit credit allocation process? So here the current process of lending is like this. So there's a at the very beginning, loan application is made. Given loan application, credit scoring is made. By using the credit scoring, credit underwriting goes on, and then the final decision is made, which is either approval or rejection. But if we can use alternative data, we can score those rejected financial consumers, and then by using the financial non-financial alternative database scores, we can make a decision such as approval or rejection. So there might be people who can get the credit even though they couldn't have access to the credit market before using the non-financial alternative data. So there might be different kinds of people, such as graduate students and housewives and self-employed business owners. They are usually called because many of them do not have a financial track record, financial history. We may not know enough sufficiently about their credit quality, how much they are credit worthy or not. So for example, this graduate student may have some savings and do some economic activities without parents help for more than 7 years by investing with the money he earned from tutoring. However, bank loans are limited because it is difficult to accumulate credit history before employment. This might be a situation of a graduate student, and there's a situation. This kind of situation. Housewife B was the chief manager of a large corporation until 2 years ago, but the career was cut off due to childcare. She has her own house and managed assets, but has a difficulty in credit activities after retirement. And also, similar situation. We may have a similar situation for self-employed business owner. So those people may not have a sufficient credit history, but we may have some other alternative information such as telecommunication information and commerce and mobile payments. So by using those information, even though they do not have a credit history, we can use those information for them to get credit in the credit market. So in some sense, in this sense, we can promote financial accessibility of those thin-file consumers. So now let me show you some current status of thin-file consumers in Korea. In Korea, we have 52 million people, and 47.6 million consumers now assign their credit scores. So most others have credit scores. My company produces those credit scores for 47 million people, and but 12 million, which is 25% of them, have insufficient financial transaction history. In other words, 21 out of 4 people are somehow thin-file consumers. So this is this can be shown by this graph. This is the credit score, which goes from 1 through 1,000, and the yellow part is the credit where the thin-filers are located in the credit score bracket, which is from 700 to 849. So if you look at the yellow part, which is about 25% of the whole people here. So here, including those people, we see they do not have any debt. So the ratio of people who have debt is much lower than this red line, which is excluding excluding thin-filers. So it tells us thin-filers that we have a lot of thin-filers in this credit score range, but they do not have credit. Many of them do not have a credit, but we don't know why they do not have a credit. Is it because they do not have insufficient information, or they do not want to receive credit? But anyhow, they do not have much credit currently. So let me explain about this graph. This is again the percentage of loan inquirers who apply for loan by credit score. And again, in this range, in the medium credit score range, we have about 3% of them in SIM filers. And also, if you look at how many of them got applied for, actually they got loans, the SIM filers, the percentage of SIM filers is lower than SIG filers. But if we look at the default rate of SIM filers in comparison with the SIG filers, the SIM filers default rates are much lower than SIG filers. So in some sense, once the SIM filers got credit, their default rates are much lower than SIG filers. So in that sense, we may need to figure out and analyze the credit risk of SIM filers. So this shows how alternative data can be used for the purpose of risk differentiation. So this line is a credit score. This is for the total people, and this is for SIG filer consumers. For the whole consumers, we can divide consumers based on credit scores above 850 and 700 to 849. This is the median group, and under 700. So given each credit score bracket, by using commerce score, for example, we can differentiate the consumer's risk further. So if we look at this credit score bracket, the default rate of this consumers is about 8.9%. 8.9% of the consumers in this bracket may default. But if we divide this group of people by using commerce score, we can find some credit-worthy consumers whose default rates are much lower than the average here. So in that sense, we can further differentiate risk by using alternative data. And also we can see for the SIM filers and the whole financial consumers how the credit, the traditional credit score correlated with the alternative information score. So if we look at credit score and telecommunication score, and also credit score and commerce score and mobile payment score, they have a positive correlation. In other words, if credit scores are higher than telecommunication score and other scores tend to be also higher, but their correlation is not very strong. In other words, the informational contents of alternative information scores are somehow different from the information contents of credit score. Because of this complementarity in terms of information contents, we are quite tempted to use telecommunication score, commerce score, or mobile payment scores, because they have somehow different kinds of information which may improve the prediction power of credit risk. So let me give you some more explanation how we can use non-financial alternative data score together with the CB score. CB score can be divided into three different groups: high score group, medium score group, and low score group. And if we use non-financial alternative data score, we can also divide in each bracket of CB score group into three: high, medium, and low. So we may now have a 3x3 matrix. For those who have high CB score, they may not have much problem to get access to credit market. But there might be some group of people, even though their CB credit score is high, whose alternative data score is low. So for this group, we may have some additional information which we may use to strengthen risk monitoring for this group of people. And if the CB score is somehow in medium range, we can divide them into two groups, which is a high alternative data score group and low alternative data score group. So if they belong to, if the medium CB score group belong to high alternative data score, we can use, you can use some strategic, we can take some strategic, some complementary strategies, such as we can differentiate interest rates and the limits of the amount of credit limits for this group. So we can give some better interest rate terms, and also we can provide more amount of credit for this group of people. So we can use for the alternative data for many different kinds of purposes. This shows how much risk predictability improve. So if we use credit score alone, its predictability can be explained by this curve. The area on the curve is called on AUC, which explain how well the risk predictability, how well performing the risk predictability. So if the line is a straight line, it means there's no predictability. But if the line goes into this direction, move into this direction, it tells the predictability improve. So with the credit score alone, the predictability can be explained by this curve. But by using commerce score and telecommunication score and mobile payment score, the predictability improve quite a lot, dramatically. So this is for simple consumers. So that's why the improvement is quite dramatic compared with this group of people, which is 6-file consumers. Even for 6-filers, we can see credit score has some predictable power. But if we use commerce, telecommunication, and mobile payment score, the predictability improve. But the amount of the degree of improvement is relatively smaller than the case of simple consumers. So this is quite natural, because simple are usually those who do not have sufficient credit information. So that's why if we add more and more alternative data, the predictability can improve quite a lot. So, and also we can use not just the non-financial alternative data score. We can also use some summary information items. For example, from telecommunication information, we may have a summary item called subscription period. And from commerce information, we may have a number of SSO login organizations. And from mobile payment information, we may have a number of delinquency events within the last six months. So by using these summary items, summary informational items, we can also see how they are related to default rates. As you can see, as the subscription period become longer, from 1 year to over 4 years, delinquency rates decline quite dramatically. And also we see delinquency rates decline. And also we see as the level of summary items increase, the default rates increase quite dramatically. So even by using just a few summary items from non-financial information, we can see that they can be used to risk differentiate from one consumer from another. And also it shows how they can improve, the summary items can improve the predictability. So given credit score, the predictability can be explained by this ROC curve. But if we add more and more summary items, we can see the curve move into this direction, which means that predictability improve. And also we can use the summary items with the credit scores. And we can find that given credit score, we can differentiate one consumer from another in terms of the amount of risk. And also I can show you some examples of telecommunication information, how telecommunication information might be used, and commerce information might be used, and mobile payment information can also be used. Let me just give you some points and then finish. If we use a credit score, we can divide them into 3 groups. Depending on their scores, we can approve automatically, and also if they are in this middle group, we may need to detail underwriting process, and if the score is too low, then we may make a decision of automatic rejection. So for those for this group in the middle range score, we can have we can give some we can have a different kind of strategy. We can alternative data can be used in the form of overriding for the rejected subjects for this group, and also we can use alternative data to discover creditworthy customers, and also we can use some strategic. We can provide some better credit terms in terms of interest rates and the amount of credit limits. And we see that even they are in simple group, about 10% of them have a very low default rates. So it's a better. So for them, they may have a chance to get a credit, and their default rates can be maintained very low. And also for online channel-based small amount of loan, we can use a commerce score. Usually, this amount of this kind of a loan is made into 2 different channels. One is a face-to-face channel. The other one is online channel. For online channel consumers, we can use 70% of them are covered by commerce score. So commerce score can be may have some power for this kind of group of people. If we use alternative information, approval rate can improve and default rates decline. And also the same kind of story goes on with the mobile payment information. For SIM filers, we have, as I mentioned before, there are 12 million SIM filers in Korea. About 1 million of them are covered by mobile payment information. So by using that information, the predictability can be quite amazing in comparison with the traditional CIVIC score, as we can compare the 2 numbers here. So, for the last point I want to make is alternative data might be useful in terms of, it can also contribute to improving the social welfare. What do you mean by social welfare as an economist? Usually, consumer surplus, we usually think of consumer surplus and producer, surplus. By adding them, we usually think of social welfare. So here, there are 12 million SIM filers whose credit worthiness might be, some of them may have a very good, credit worthiness. So if they can have, access to the credit market, their welfare might be somehow improved, but they might be better off. And also financial institutions may find some credit-worthy consumers even with the financial management maintaining their default rates at a very low level. So in this sense, both consumers and there's a chance in which both consumers and creditors can be better off. In that sense, we may use alternative data to have more improve social welfare. So this is my presentation, and if so I hope this gives you some useful information. Yeah, thank you.
Thank you, Dr. Kim. Until now, we have three quite interesting presentations. I think we are on time, but I think we'd better take a 5-minute break. We will start panel discussion from 45. Thank you.
Okay, thank you. Yeah. See you later.
Is it possible? I would like to ask to express my comment at the last time because my throat is not healthy. So is it possible to change my order?
So you want to discuss as a last discussion?
Later. Yeah.
Okay.
Yeah.
And why don't we start from Professor Sojong Park, who is on site here.
Okay, so I was just still okay. There's a file link. Can you turn off? 이거 음성 범위가 그래서 그러네.
Then remove all this. So much.
Okay, so can Can you hear me? Right. So actually, about my question, I already asked the question to the presenter, so I will just briefly discuss this paper. So it was a really interesting paper to go over because I was also very interested in this topic of proxy discrimination. And was really helpful for me to clarify my thoughts and put together my thoughts by reading the paper. And although the presenter actually explained it pretty well, but let me briefly go over this. Okay, maybe there's following. Okay, what should I do? Okay, is it good, or do you still have problem? Oh, okay, so okay, let me briefly go over the idea of risk classification, especially in insurance industry. So why do we classify? Actually, there are two major reasons. The first one is if we don't classify, there can be this adverse selection, and that may result in the market failure. So we definitely, want to classify people if there is some possibility for adverse selection. And the second reason is that, just to be fair, here fair means actuarial fairness, which means if we do just want to charge more for those people who will have more loss, we think that's fair, then we want to classify. But then there are reasons why we don't want to classify. The first one is if it is too costly, it doesn't make sense to classify. So the cost is one reason not to classify. And if it's too costly and if there's too much adverse selection problem, and actually we may just simply result in market failure. And the second reason is the topic of this paper is even if we can classify people at a low cost and has some prediction power, so it's actuarially fair, we still do not want to classify people if we think that classification may harm the social equity or unity, because it has some feature traits like race or religion, such as stuff. Okay, was not me. Okay. So it's related to that discrimination topic. So as the presenter said, even if for those factors here, for those discriminative factors, even if they are related statistically, we still do not want to use these factors for I think it's for two reasons. That's the point I tried to make earlier. The first traditional reason is that even if there's a statistical relationship, it's really hard to provide this causal relationship. So African Americans, they tend to have a high, risk, high loss, but it's really hard to prove that there's just some causal relationship, and just simply charging more for a certain race seem to be simply just discrimination. So in our society generally, in pretty much all states in the United States, ban using such a factor. And the second reason is that the one we learned today is certain factors may induce undesirable behaviors, like reporting domestic violence or going through genetic testing. If we use those information and classify based on that, actually it may kind of make people not to take those tests and not report such an important information, and that's just socially undesirable. So we may just simply want to ban using those factors. So the bottom line here is in terms of risk classification, we want to classify people because that is fair and will reduce the adverse selection problem as long as it does not have this it's not costly or it's not that discriminative. But now we have, because of that, we have these vectors like the race, religion, ethnicity, and etc. And we tend not to use those things. And in reality, actually, it's not that simple because, as you can see from this figure here, depending on states where you are in, even in US, like for example in California and in Massachusetts, they strictly ban using stuff like a credit score when it comes to auto insurance pricing. But some other states like Michigan or Indiana, actually depending on your credit score, your insurance premium may double as well. So what really is discriminative and what shouldn't and should use, it's kind of there's some debates and it's very controversial factors. And then when it comes to this new AI or machine learning, we have even more complicated problem because traditionally we have these discriminative factors like, okay, you are African American and you are white. Then it's not necessarily, for example, it's race like African American always associated. The fact that you are African American simply means you're high risk. It's like there's no causal relationship, so we do not want to use that race factor as a factor of insurance premium. But in statistical relationship, somehow they have a high correlation with with these risk factors. That's just what we have found. And the reason is that probably these traits have something to do with the underlying behavior or some other factors. And that underlying behavior, if we use this big data analysis or AI, we can directly somehow figure out that behavior itself, like reckless driving when it comes to auto insurance. And simply we have used this reckless driving, like a speeding behavior. But if we later compare the score between race, maybe certain race have a higher score than the other race. So it seems that we have simply used, desirable like driving, behavior to score this, loss probability. But then at the end of the day, this score may seem to be related with what was previously defined as a discriminative factor. And if we simply call these as proxy variable that proxies these traits, my question was, is it really the case, or should we ban using these factors or not? I do agree with the fact that if there is a certain other factors or algorithm that simply kind of to directly measure these traits, that should be banned. But it's absolutely possible that this behavior, the score will be automatically somehow related with the race or religion kind of stuff, then it's actually a much more complicated issue. I think, like, when we want to call what is a proxy variable, probably at least, I mean, a proxy variable, I think we probably want to, define these two proxy variables, the one which tracks down that behavior that directly have some sort of causal relationship with the risk, and or the other proxy variable that actually really proxies the trait itself. So that was my concern. And that was already discussed. And I want to discuss one more thing. This is a Korean issue. So actually, this week, I went to this meeting and was actually related with today's topic. So for the first time in Korean life insurance company, they decided, one insurance company brought up this new product that they will use a credit score as a factor to, pricing factor for life insurance, right? So, I mean, no insurance company previously used these factors like a credit score to, use any type of insurance in Korea, although it is widely used in US when they, price auto insurance. But then I think this is pretty controversial. So even, before we get into the proxy variable in Korea, actually, it's not even very rigorously defined what is discriminative factors or not. Like, should we allow insurance companies to use, say, income or wealth or credit score, when they priced these like life insurance and auto insurance, because definitely there is a high correlation between credit score or income with life insurance or auto insurance losses. Do we want to let people, insurers, to use these factors or not? We probably predefine these things first before we want to talk about, proxies and etc. In Korean case, because at this moment, actually, it's interesting to, at this point, credit score could have been used, much earlier, like even 10 years ago. I think definitely companies could use these factors as a pricing factor, but no insurance company actually attempt to use those new factors. But in recent years, now everybody is talking about digital transformation, searching for alternative data, and looking for a new way or better way of pricing. And then we are coming up with these new factors that was not really traditionally used in the insurance industry. And those are some factors, even not reaching those fancy AI, it could be directly controversial, like a credit score. So we probably want to think about what we want to do about these new factors that insurance companies may want to probably bring up in the following years. Like, for example, other example is like generic information. It's not rigorously defined about whether companies can utilize this information or not, unlike US or Canada. So that's my discussion. Thank you.
Okay, thank you. Okay, thank you for the comments. Next, let's move to Professor Sujin Park, who will discuss about the third paper.
Okay, can I share my file here, the PDF file? Okay. Do you see my PDF file? Where?
Yes.
Okay. Let me begin. So good afternoon. I'd like to comment on the impact of the alternative data in the market for the consumer credit. In overall, I would like to appreciate the research, not only because of the beauty of the analysis report, but also the authors' great effort for establishing the rare and the broad data set. The study is meaningful mainly for the two folds. I think this study is empirically showed the use of the alternative information that can increase the financial inclusion, whereas the decreasing the expected default rate. It was possible because of the private data accessibility. The author, Dr. Kim, is in the key research position of the CB industry. As all of you know, the application of the alternative data can reduce the information asymmetry and adverse selection problems in lending industry that can contribute to reduce ex post default rate while increasing financial consumers the coverage. In macro level, in overall, the increase in quantity of financial service at proper level of the risk price will cause the financial consumer surplus. Let me discuss more in detail on the analysis result. Okay, so let me change the file. So from the left side, I mean the ROC graph on the page 16, it is surprising that the predictive power of this model improved a lot, huge, when the alternative data are applied to the thin file customers, which group is hard to evaluate due to the lack of traditional financial data. It is also surprising that the portion of the thin filer customer is approximately must be page 12. Yeah, approximately even 25%. It is one fourth of the population, which is huge. It means financial institutions could have waived or neglected this big portion of the customers due to the lack of the traditional financial information. As a result, it is expected that the usage of the alternative data may contribute a lot when it is applied to the thin file customers. This will be more effective when it comes to developing economies, different from Korea, as they in the developing economies it tends to have a higher rate of the thin filers. I would also appreciate the author show the impact of the three alternative data one by one. So, for example, telecommunication information in here, page 19. So yeah, I was so surprised the impact of the including the telecommunication information improved the accuracy of the estimation. Also in the next page, yeah, here comes the impact of the commerce information, and the next page is about the mobile payment information in separate. One thing that I wonder, is the estimation model, which is not explained in the presentation. I guess the author used either logit or project model. It would be appreciated if Dr. Kim could give us an idea what kind of model and how you used to estimate this kind of improvement in credit estimation. And also I just suggest if author used either logit or probit model, I suggest it could be improved by applying non-linear models such as deep learning, considering the title of this seminar is AI and big data. Yeah, in overall, once again, I appreciate a lot, and thank you very much for listening.
Okay, thank you. And if Dr. Kim has any reply to the comments, you can do it later on. You don't have to if you don't want to do it, but yeah, let's do it later on. Then let's move on to Professor Son, if you are ready. Jungkook Son.
Yeah. Yes. Sorry for my online joining as a commenter. I would like to make an excuse for this. I wanted to be there, but I had caught a summer cold, but even a dog does not. And open cups exploded for a second without stopping. So my wife advised me staying home. Then I have to follow the advice because, as you know, it is not advice but an order. Anyway, I'm very sorry for not being able to join the great dinner after this seminar. Professor Chung mentioned earlier this seminar. I have question for just one question. Thank you for informative presentation with colossal research for Dr. Son. And I think big data has an immense influence over each financial industry. And I can assume that we cannot clearly say what change big data will bring about now. At this phase, I have just one question. Insurance is an industry that covers the risk of our colleagues. And adverse selection is undoubtedly a critical problem, but the reverse is a huge problem too. So, what if the insurance companies use big data to screen people with dangerous factors? This question is related to the second presentation, the discrimination. So my question is there any way to limit insurance companies from using big data for this purpose in our country or worldwide? That's my question, just one question.
Okay, things are moving faster than I originally thought, which is fine. And then let's move to Professor Hoshino. And thank you for waiting for a long time. And also thank you for participating to the seminar. So the floor is yours. Yeah.
Thank you very much. I may be heard.
Yeah.
Okay, thanks. This is a great honor and a pleasure to be able to join this prestigious meeting of Iafico. I'm very grateful to the chairperson, everybody here that allow me to be there. Let me show a very small and primitive slide I prepared for this meeting. Am I showing this?
Yeah, we can see.
Yeah. Okay. My name is Akira Hoshino again, and I've been working for Japanese insurance industry for about 30 years. So I'm very new to the academic side of this insurance. And so my perspective will be mainly on the insurance companies side. So I would like to touch upon what kind of changes will be taking place on from the insurance company's perspective, and then try to look back from the implication to the customers or consumers. First of all, I like to say that this is not simply the era of new technology. This is era of trend of new technology. I mean, that all people in this industry keep saying that this time is different. This is a new era of technology, but they keep saying that for quite a long time. Since the beginning of the internet in the early 1990s, people say that this is a time for the change. So what is different today compared to a few decades ago? The point is that there are so many things going around at the same time in a very short period of time. We have AI, we have biotech, we have quantum computing, robotic process automation, blockchain, automated driving, drone, space technology. So many things are moving in a very short period of time. So it's very difficult to understand the full implication without having a framework. So my framework is very simple. It is kind of embarrassing to show this, such a primitive diagram, especially after the excellent presentation by Dr. Son about the value chain. But this simple thing may work. We divide our business on the operation side or the internal works within the company and the market side to meet the customer needs. If we apply the new technology to the operational side, mainly it will make impact to the market in an indirect way. The new technology on this operations side will usually lead to the cost reduction. And at the end of the day, we will have a lower price and that will impact the market. And many companies try to directly apply new technology on the marketing side. If you think about the famous GAFA, the Googles or Apple, Amazon, those companies all make move to directly to the customers, and that they created a big business. But the insurance company, if you can improve the operation by 10%, there are so many hundreds of operations. So it will only reduce the premium by very small percentage, probably some decimal points. So the direct innovation on the marketing side should be the big game changer. So hence the hypothesis, all the GAFA will directly touch customers, the consumers, without any intermediary. So the hypothesis is that if this thing would to take place in the insurance industry, probably the market share of the direct writers will be growing. The data, at least in Japan, doesn't show that way. The old-fashioned sales personnel, old-fashioned fashion agents sell declining, keep declining. But which is increasing is new types of agents, mostly non-type, but they sell things by face-to-face, and they are still some intermediary. Direct writers showed some market share, a bit less than 10%, but it's declining. This is about the life market in Japan. General market in Japan, agents still have 90% share. The direct writers is still less than 10% after a few decades of marketing. So what is the implication? Let me skip a few slides. I don't have this much. This is one trial done by a Japanese small direct insurance company. The CEO of that company took the lead, and he drove the new way of marketing. He found out that it takes 30 clicks before the customer sees the price, the quote. And most of the customers are discouraged during the process, and they just simply leave. So he created a system that if you click just one time, and you get some approximate price. It's not really the pricing. It takes a few steps and need much more information. But to let the customer not go away so quickly, he created some very high-tech this smartphone application that will bring a customer to the quote. And this should work, but after this invention, the market still looks this way. So market side impact is probably still on the way. It may bring huge benefit to the consumer, but not quite sure. There has been many new ways of marketing, but very few of them remained in the past. The other side is operation side, and there are some concerns and some expectation from the customer's point of view. Tokyo Marine, one of the mega insurance group in Japan, produced a new way of anti-fraud detection system, and they introduced them in a series of product lines, automobile, personal injury, and recently homeowners. Either they created their own or they tied up with outside software companies. And this system basically calculates the score based on the contract and the claims report made by the customer, and especially for these homeowners, weather conditions and other outside data. And based on their score, they insisted that they can narrow down the suspected cases without looking each of the cases one by one. And they can list up some of the suspicious cases and take a good, deeper look at it. This may be good for some customers, but there is always some risk about the accuracy or false judgment, and a lot of things. So basic idea, new marketing should bring benefit to the customers. And we have big expectation, but I don't think it is just a coincidence that Amazon started their business from books or music CDs, because those things are very typical that you don't care from whom you buy. No matter where they can get it, the product is the same. So there should be no difference. Probably insurance may be a bit different. Insurance is all about the trust between the customers. So many people care about from whom he buys insurance. So new marketing may be promising, and it should only bring benefit to the customer, but still it's on its way. We are not quite sure that this will be really a big move. On the other hand, the improved operation normally gives a better, smooth operation, and that will give a good thing to the customers, but probably we have to have some concern about the false judgment, especially in underwriting and in claims services. Thank you very much for your time. I'm afraid that I hope I didn't talk too long. Thank you.
Okay, thank you. Thank you very much, Professor Hoshino. Next, let's move to Professor Le, joining from Vietnam.
Good afternoon, everyone. And first of all, I would like to say thank you to the organizer for giving me a chance to present, some insight from Vietnam. And I would like to share my short presentation now. Have you all seen my slides? All right. So as we know, we are here in this Iafico seminar about big data, AI, and the consumers in the insurance and lending sectors. So I would like to give some insights from Vietnam, mostly from the industry point of view. And first of all, I would just like to point out first that the application and development of big data and AI in the financial industry in Vietnam is still quite limited. Like we are still at the emerging initial stage of the development of big data and AI. So I would like to show, what have we progressed so far and what we might see as, problems during the development progress. And my presentation will be divided into two parts, the insurance sector and the lending sector. So first of all, about insurance, then I have two specific cases to talk to you about here. The first insurance company is Prudential Vietnam. In 2017, Prudential Vietnam introduced a chatbot in providing insurance consulting. So instead of, consumers have to call the customer service and wait for the response over the phone, now the customers can directly type their question and ask for the chatbot, and their queries will be automatically handled and replied, within a second, based on the preset situations, and the computer will keep learning as it interacts with the customers. And in this way, the customers can ask for support anytime during the day, any day of the week, and they can ask for anything from product information or any sales programs that they might be interested on. And in Vietnam, this chatbot is run on Facebook Messenger, and customers find that it works really well for them, especially for office people working in office who might find it difficult to, contact the customer service of the insurance company during office hours. And some surveys from the company shows that they really improved their communication with the customers, and the customers agree that they receive better service, consulting service from the insurance company, and the customers really like it because they can have more proactive roles instead of just waiting. And the second case I would like to bring here is AIA Vietnam. AIA is among one of the top tier insurance company in Vietnam that is applying AI, and their signature AI product is My AIA, which is an application that the customers can modify personal information. They can also manage the insurance policy contract. They can do some basic transactions, or even they can send requests to claim the insurance benefits and keeping track of the progress. So for example, that the customers can make a request for payments and receive the benefits money within just 15 minutes by being at their house. This is really a big progress, because in Vietnam, in the past, I would say like 5 years ago, if you want to claim for insurance benefits, then you need to fill in a lot of forms. You need to go to the insurance company, submit your application, and the whole process might take days for you to receive the actual money. But nowadays with AIA, with this application, it takes only 15 minutes and you don't need to go anywhere, with just the comfort of being at home. And the company estimates that the accuracy rate of the AI application here can go up to 99%. So it really helped to reduce the time necessary for the valuation of the policy. So as you can see from these two examples, the application of AI in insurance sector in Vietnam is still quite limited. However, we do realize some concerns that need to be tackled if we want to further develop AI in insurance sector. So first of all, it is a limited database. As you all know, AI, the machine requires a large database in order to work effectively. And in Vietnam, the database is really limited. That is not to mention that each person does not have a virtual identity. We might have, some identities, but these identities are not the same across different platforms. It can create some challenges for the insurance company. And the second concern is the data protection from the customers. I think this is a concern in everywhere, not only in Vietnam. And for us, it is a large initial investment that is a big concern for insurance company when they think about, utilizing AI or big data. This AI technology does require a large amount of money, investment money at the beginning. And the benefits from this application will be really slow and be spread over the years. That is not to mention that the insurance companies would need skillful staff who knows how to operate this AI technology, and this can be problematic. And also there is currently lack of a legal framework for AI application in insurance in Vietnam. We are still in the experimenting and trialing with some rules, but at the moment there is not any legal guidelines for insurance companies. And last of all, some insurance companies do see AI application as a means to reduce the staff cost. So if insurance companies in Vietnam do think so, then we will have a problem of job loss. Millions of people working in insurance sector might lose their job in the future. And these are the biggest concerns that are from the industry that we can see. And now I would like to move on to my second part, which would be about lending sector. And I would concentrate on credit scoring, as it is a topic of our third presenter. So we all know that the lender needs sufficient information about the borrower when they make a decision to give the loan or not. And in Vietnam, historically, the lenders relies on information from traditional and non-traditional channels. Traditional channels would be like the employment history of the borrower, the income, and any credit history. Non-traditional channels would be how the customers interact with the bank staff when they enter commercial banks, that sort of things. But nowadays, I would say in the past 5 years, the AI application has really grown up in credit scoring in Vietnamese commercial banks, and we do have a lot of potential for AI development, as 70% of Vietnamese do not own a bank account. I think this rate is really, really high. And as the majority of them do not have a bank account, we do not have a credit history. So if these these people among 70%, if they want to apply for a bank loan, then the commercial banks would be in trouble, like they have no credit history to access. And about 60 million, that is around 60% of our population, which are potential borrowers that with low income, and they cannot access traditional bank loans, cannot go to the bank and ask for a loan just because of their lack of history and with their low income status. But we do have a high rate of smartphone usage, like 72% of urban population owns a smartphone, and the rate is 53% in the countryside. Looking at these statistics, credit scoring companies nowadays, they do employ mobile phone data of the borrowers as an alternative data source, we know. And this data provide insight into the behavior patterns. And within the past 2 years in Vietnam, these companies started to incorporate data from social media, e-commerce, internet behavior, and other financial transactions. And this data go through the machines, and the machines create a rating, as we all know. And that has been the development so far. However, we do see some rising concerns. First of all, it is equity. The second guest speaker, we're talking about discrimination, but I would like to use the word equity here because I think there is more to discrimination. There is also a sense of fairness here, that the machines might give some bias to some sort of vulnerable groups, like poor people, women, ethnic minority, and others. But there is also the social prejudice, because the machines learn from the behavior, the data related to behavior patterns, and behavior patterns can indicate sort of social prejudice. And if this is something that we really need to think about, because as a society, as a human, if we even cannot decide, on this social prejudice, then how can we rely on a machine to sort this ethical problem for us? And the second concern is transparency. The algorithm, they make an analogy like algorithm is like black box. You don't know what is happening inside the box. You give them the input data, and the machine will tell you the output. And sometimes the raters and the lenders cannot explain to the customers the reasons why they reject the loan application and on what ground. And I think this is a big problem for loan applicants. And finally, it is the cybersecurity. In Vietnam, I have some statistics to share. Like in 2019, over 330,000 cyber attacks were happening. And in these attacks, the thieves were trying to steal the users' accounts. So it was really alarming, especially for celebrities or, like well-known people. And in the same year, there were over 21,000 attacks that the thieves were using fake information to access user accounts. So stealing ID is a common cyber attack in Vietnam. And also within the past 2 years, there is such a thing that the thieves were trying to cheat the rating system. By this, I mean they were creating some sort of fake data that indicate, the behavior on social media. And when the rating companies use the data from social media to, give a rating to these customers, then of course the system would give a really high rating. But why actually all the input information were fake? So this is something that the authority in my country is thinking about. And just to summarize what is happening in Vietnam now, people really have good attitude toward AI and big data, because these can provide accuracy, efficiency, and escalating the speed in in calculating the credit risk. But we do have concerns over transparency, equity, privacy, autonomy of the customers, and finally, there is currently a lack of legal framework. Like if we learn from experience of developed countries in the West, these Western countries, even they have to change the credit law, how they define, credit and discrimination, these terminologies in order to facilitate AI and big data. But in Vietnam, we are still in the process of finalizing and developing our legal framework. And a lot of fintech companies in Vietnam, they're really looking forward to the day then when their activities can be supported by some legal guidelines. And that would be everything about my presentation. Thank you very much again for giving me a chance, and thank you.
Okay, thank you very much. And this summer, we will have the Iafico's annual conference in Hanoi. So some of us, a number of us will participate there on site. So I'm sure we can meet each other. So thanks again for Professor Hoshino and Professor Le for sharing your thought. Now we have some time left for the discussion, floor discussion, before we go to the presenters to see if you have any responses to the comments made earlier. Now I have one written question from Professor Sung-Soo Kim, which I think everyone can see her question. It sounds like which one to regulate, say between variables included in algorithm or machine learning AI itself. If I'm not translating your question correctly, then please feel free to jump in. But the thing is, we don't have Professor Schwartz, but we have Professor Sojung Park. So maybe you can share your thought if you are willing to. But one sort of related question I had is the proxy discrimination that we learned from Professor Schwartz. I'm curious how significant issue it is outside the US, say in Korea, in Japan or Vietnam, I don't know, but you know, it may be quite specific socioeconomic issue in the US, or it may be a more general and universal issue. I'm not sure. So if you can share your thought on that issue, I think it will be quite useful.
Yeah, I don't know. I'm not that sure. Actually, apparently, I think this discrimination is less important issue than in Korea than the US.
Yeah, you can come over here.
Yeah, I think that discrimination is just less important issue in Korea than US apparently, because we are much more homogeneous than at US, where everybody's really heterogeneous and have so many discriminative factors, and that's probably why we don't have this very definitive kind of banned factors. As far as I know, that's like religion or nationality. I mean, those just but not really meaningful because we don't have many of those discriminative people here. But as I have raised earlier, but now the smart algorithms, if that they get really smarter and smarter, even if we have not really defined those discriminative factors, it's very possible that these factors figure out who's, end up with discriminating rich versus poor people. One possibility, like although we have not really used the information like the income or credit score and etc., but maybe we end up discriminating those people in insurance pricing. Using credit score in this in credit risk part is apparently that's the way we want to do, but using these information in auto insurance or auto insurance or life insurance, some other insurance, that can be some other issues. For example, like we have such a thing like now if you drive more, so for example, if you drive more, you have to pay more. We with all these mileage discount to pay as you go scheme, but it's possible that those people who have to drive around a lot for their living may have to pay more if we have this better price scheme. And then I think as far as I know, we don't really have some sort of agreement upon what we want to do. So far I think it was not a big issue, but it's absolutely possible from now on. Some people may think this could be controversial, so we probably want to think about these issues. But we have much less important. It's because we don't have various race or ethnicity whatsoever. But when it comes to income, I think we probably want to think about this issue one time. That's all I have. Yeah.
Okay, so before we go to the presenters, is there any other question? Either from online or offline? Professor Hong-Moo Lee, Dr. Lim, Professor Yu. If not, let's go to the presenters, two presenters who are still here. Then after that, I will make a closing remark, and I might share a couple of slides for that. But I do want to ask one question to Dr. Son, because one of the things that Professor Sojong Bak mentioned was quite striking to me. In the insurance industry, I was told that the credit score would be used pretty soon. Then if it was not used, then how the consumer-related risk in the insurance industry was assessed before? Maybe it's based on some, the different variables, but I presume that consumer-related risk is one of the major types of risk that insurers will have to worry about. So why don't I add that question to you? Okay, so maybe you can go first. Yeah.
Let me get into first your question. Actually, there is something that I may comment, because when I heard about the credit score for using the insurance companies, Professor Sojong mentioned, I quite interesting. But what something that comes to me is that the using credit score in the case of US, especially for the auto insurance or life insurance, let's say auto insurance. Actually, the reason why the auto insurance company using the credit score is because they don't know about the real risk of drivers at the time, because there are no much of data. But right now, I guess the auto insurance really trying to not to use credit score. Actually, they don't need to use credit score. Rather, they try to collecting other information like behavior data from actual drivers. So I guess in, let's say, for in my country, I mean, the Korea, if I am the auto insurance company, I'm not going to try to getting credit score for measuring the risk of a driver. Rather, I try to getting more information like the driver's behavior or the use of the they drive. So that is something that what I think. And also life insurance. Also for the life insurance company, what the important thing is getting the measuring the risk of life expectancy, right? And then in the US, the same reason auto insurance, they try to getting more information, but it's not easy. So they try to use the credit score, because measuring the risk of life is too much, right? So they try to using that information like the credit score. But right now, they can get more information from the SNS or the, as he mentioned, that telecommunication or something else. So I guess it's not that much worthy to using credit score, I guess, right now. So I don't know, maybe this kind of things is life insurance company and auto insurance company try to get some decision whether they use the credit score or not. But if they are living in the past, they try to use credit score. But right now, I don't think they don't need to do that. That is what I thought. And Actually, I don't get the right question from Dr. Professor Son. So is it the question about the limitation of the big data for insurance company or something like that? I don't get the right question. So maybe I can get him later on. Yeah. And then one more thing, I really impressive the presentation of the Professor Akio Hoshino, because the situation that he mentioned in insurance company in Japan is exactly same as insurance company in Korea. As he mentioned, there are limitation of big impact in the Japan. Actually, the same in Korea, especially for the life insurance company. So what I thought is maybe the customers in Japan, what the pain point of them is not about the technology or something. Is maybe because of they really want to compare the product rather than using new technology. That is why the general agent in Japan is much more popular than the tied agent or the direct line. That is what I thought. And then Tokyo Marine, he mentioned about big company. And then the main strategy of that company, as far as I know, is not focusing on domestic market. They try to looking at the outside of Japan. That is the reason they try to invest much more the big technology or big fintech or insurtech company, not focusing on the domestic and in the Japan domestic market. And also the presentation in from University of Vietnam. And then actually what I know is even if you use wonderful technology or a level of AI, you don't need to worry about the loss of job in insurance company, because if you understand the process of underwriting in the insurance company, it's not easy. So even the AI replace the part of the underwriting. So even if you use AI technology for doing the underwriting, it is not possible to replace that underwriter. So actually, you don't need to worry about them. That is it.
Thank you. Let me briefly make just a few points. There was a question about what kind of a statistical model was used to produce the analytical results. Actually, we for credit scoring, we use a probability of a default model, which we call it PD model. The common model we use in this area is usually logistic or probability model, as Professor Park mentioned. And also we may ask a question of whether data and statistical model, which one might be more important for better predictability. Here in this presentation, I try to use more data, different kinds of data combined with the traditional ones. I showed we can improve the predictability, but as Professor Buck mentioned, we may also try different kinds of model, because we have big data, we may also use some fancy statistical model such as machine learning technology. So if we use a machine learning technology, there should be some conditions. Usually we use a machine learning technology if there are too many variables, like hundreds and thousands of variables, which we do not know how they are related to the behavior of consumers in terms of delinquency or default. So if we have too many variables, and if we do not know much about how they are theoretically related to the outcome variables, we may try to use machine learning technology. So I think it might be very interesting. So because since we have a lot of too many hundreds and hundreds of information in terms of even in telecommunication information, and also commerce information, we have actually hundreds of information, but we do not know which variable might be more important than others. So I think we may try to some different kind of statistical methods. And also I think with regard to Professor Led's comments, I think institutional settings might be somehow important to introduce some fancy technology or some big data technology. So in Korea, as I briefly explained in the very beginning, in Korea we had amendments to the 3 data laws in 2020. So after the data law amendments, we could combine different kinds of information and produce a big data, and then we now can apply many statistical models. So before that, it was very hard to combine different kinds of data. So I think institutional settings might be very important to if we want to introduce different kinds of data related technology. Yeah, thank you.
시간이 좀 남아서. Okay, so I will just briefly show you a couple of slides. It will not take long as a closing remark. And the motivation of this seminar was, in fact, from these slides. What you see here is the frequency of the articles, about 26,000 articles that we extracted from Web of Science out of the keyword search that are related to data economy. Data economy is essentially digital data platform and AI related keywords. And from Web of Science, and we identified about 26,000 articles that are written in English. So, there must be a lot of other articles to that subject. This is all about, these papers are from finance field, different financial services. And then we did the same thing for the medical science. And there we could identify about 260, a lot more articles. But after about 2014, there has been a explosive growth of the article. So all these finance as well as medical science articles came out during last 6-7 years. And then for the finance papers, we extracted the top 100 papers based on the index the quotation, citation index. And then more than 70% of those top 100 papers are about two topics, machine learning and big data. Then in the medical science articles, we try to divide the 5-year period and then identify the top 20 keywords. And if you see the most recent 5-year period, it's almost all about artificial intelligence, the machine learning, neural net, algorithm, and so on. And then deep learning. Deep learning is a part of machine learning, is a fairly new concept. It did not appear in the prior periods. So it came out fairly recently. So the main implication is that we talk a lot about big data and machine learning, but they are fairly new phenomena, both in academia and in the industry. That's what we feel as a key implication. And then I don't want to go into the machine learning and deep learning details, but these days there are a lot of softwares that enable to use the machine learning and deep learning algorithm to process various kinds of data, the text, and so on. Even my friends, some of my friends who are over their 60s are trying to learn things like Python, R. So I'm thinking about the same thing if I have more time. But then I think the challenge is especially in for those in academia appears to have a challenge in this nature. There is at least in the economics literature, the machine learning based prediction appears to perform much better than the traditional econometric models. This is from one article in Journal of Economic Perspective published in 2017. So they compare several machine learning based prediction for the same thing and compared to the traditional econometric model and show that the distribution of R-square for different segments of sample indicate that these machine learning algorithms perform much better. Then the problem is this. This is from the person named Bryman. He's a statistician, very famous statistician from Berkeley. The traditional approach in the empirical analysis is number one, the first approach. We collect X variable and try to use X variable to predict Y. And then only thing we care is about beta, the right sign and statistical significance of beta. And we assume a particular statistical model represents either nature or society. That's what we claim. And then in the empiricist jargon, we torture data until it talks, meaning that we dissect and do various things on the data to get the beta that you want. Basically, that's what we have been doing. But then with the AI and the big data, they don't care much about beta. And in fact, we cannot infer beta that well from the black box. And they assume they don't know about this black box that we label as nature or society. But then they try to find the function that minimizes the mean squared error. So they don't care about the beta, whether it has a omitted bias or anything, but they try to get the best possible function that minimizes mean squared error. Okay, so Mr. Bryan's claim is that this kind of sort of inductive research will receive a lot more attention going forward compared to the traditional deductive research, which starts from theory. Then the problem is, if you do this, not many economic journals will publish your article. So we are still in the first traditional deductive method, but then things are moving fast to have a more meaningful inductive data analysis. So at least in academia, that's a sort of dilemma that we have. But in the industry, let's say getting a best possible credit score, I don't think you have to worry that much about beta. You need except when you have to worry about proxy discrimination or some specific variable related results. But essentially, minimizing mean squared error can be a plausible objectives in the industry. So, as in many other things, I think industry can be far ahead of academia in embracing this kind of sort of paradigm change. So with that, we can have a nice dinner, as Professor Chung mentioned, one of the greatest pleasure of human beings. So with that, I appreciate everyone who participate, and have a nice week and nice evening. Bye.
Okay, on behalf of Iafico, I would like to sincere thanks to all of you, participant and discussant. Especially my thanks goes to Miss Julian Kim. Without her, we could not make this wonderful seminar today. Let's give her and us a big, warm round of applause. Thank you. Right.